All right, today we're pulling back the curtain on a massive, hidden battle. It's happening every single second, right inside our global financial system. We're talking about the fight against money laundering. It's the one question every criminal organization has to answer. It doesn't matter if you're a drug trafficker or a corrupt official, how do you take all that cash you made from illegal activities and make it look totally legitimate? Let's get into how they try to pull it off. And the scale of this problem? It's just staggering. Get ready for this number. A 2023 estimate suggests that over $3 trillion in illicit funds sloshed through the global financial system in just 1 year. To give you some perspective, that's more than the entire economy of the United Kingdom. It's a mind-blowing amount of money. So how in the world do criminals even attempt to wash a mountain of cash that big? Well, it turns out they follow a surprisingly consistent playbook, a kind of recipe for financial deception. It really just boils down to these three core stages. First up is placement. This is all about getting the dirty money into the financial system in the first place. A classic technique here is called smurfing, making tons of small cash deposits to fly under the radar. Then comes layering. This is where they create this incredibly complex web of transactions just to hide where the money originally came from. And finally, you have integration. This is the end game, where the now clean money is brought back into the legitimate economy. Okay, so to fight this, the first line of defense is designed to stop criminals right at that very first step, placement. And this is where financial institutions like your bank step in to be the gatekeepers. They do this using a process called Know Your Customer, or KYC for short. You've probably experienced this yourself. Ever opened a bank account and wondered why you have to provide so much ID and fill out all that paperwork? Well, this is exactly why. It's the bank's legal responsibility to verify who you are and make sure your money is coming from a legit source. I love this analogy. Think of KYC as the welcome mat. It's that one-time check when you first walk in the door and open an account. But, and this is a big but, the process doesn't stop there. That's where customer due diligence, or CDD, comes in. CDD is like the security camera. It's always on, constantly monitoring account activity. And that ongoing investigation, that security camera, it is absolutely crucial. Because even if some dirty money gets past the welcome mat, those cameras are always watching. And they're looking for the suspicious patterns that are going to give the criminals away. So what's really important to get here is that customer due diligence isn't a one-and-done thing. It's a continuous process. Banks are required by law to keep an eye on accounts for their entire lifetime, watching for any red flags that could point to those layering and integration stages we talked about. Here in the U.S., the Financial Crimes Enforcement Network, that's FinCEN, lays out 4 pillars for this whole process. And it's not just about checking your driver's license. Institutions also have to figure out who really owns and benefits from a company. They have to understand the purpose of the account, and of course, they have to continuously monitor transactions. So what happens when those security cameras spot something that just doesn't look right? Like, say, a bunch of small deposits that are clearly designed to avoid detection. Well, the institution doesn't just shut the account down. They are legally required to file what's called a Suspicious Activity Report, or a SAR, with the authorities. And that report is what officially kicks off an investigation by law enforcement. But here's the thing. Money laundering isn't a local problem. Not even close. It's a global one. A criminal in one country can bounce money between banks in 10 other countries to cover their tracks. So the fight against it has to be global too. It requires this massive international alliance of governments, law enforcement, and financial institutions, all working together. You can actually trace the history of these laws in the US and see how they've ramped up in response to major world events. It really started back in 1970 with the Bank Secrecy Act, got way more intense in the 80s to fight the war on drugs, and then saw a huge expansion after 9/11 with the USA Patriot Act, which really honed in on cutting off terrorist financing. And on the international stage, you've got these huge players all working to create a global standard. We're talking about the Financial Action Task Force, the IMF, the United Nations. They're all trying to make sure there are fewer and fewer places for criminals to hide their money anywhere in the world. Yeah, the mission of the Financial Action Task Force, or FATF, it really says it all. This one organization sets the standard for AML regulations in over 190 different jurisdictions. It's all about creating one unified front against financial crime. But just as this global shield gets stronger and more coordinated, a whole new frontier opens up. And it's created what is easily the latest and most complex challenge in this high-stakes game: cryptocurrency. Think about it.
The very things that make crypto so appealing to some people, its pseudo-anonymity, the fact that there's no central bank in charge, well, those things also make it an absolute dream come true for money launderers. It's a system that was basically designed to operate outside the traditional regulated financial world.
And you can see the impact right here. I mean, wow. According to the blockchain analytics firm Chainalysis, illicit crypto transactions just exploded to nearly $40 billion in 2022. Now, you can see that number dropped quite a bit in 2023, but it just goes to show you how volatile and how significant this new battlefield has become.
But the regulators aren't just standing still. They are fighting back with brand new tech, like blockchain analysis tools that can actually trace transactions on the public ledger. We've got new laws like the AML Act of 2020 that now cover crypto exchanges. And there are new international standards like FATF's travel rule, which are trying to bring the same kind of transparency to crypto that we have for bank wires. It's a constant game of catch-up, but the fight is definitely on.
And that leaves us with a final, really crucial question. The very nature of money itself is changing, right? It's becoming more digital, more borderless. So in this new world, how will that global shield we've spent the last 50 years building adapt to win this constant, evolving game of cat and mouse? What do you think is next?